I tested 10 plus strategies with a real account, and this one made almost 300 plus pips in the last 30 days. This is a trend continuation pullback. So time frames, we shall use H1 or H4. Why? To filter out the noise. That's why we shall use higher time frames. So for the pairs, we shall use Euro USD, GBP USD, or USD JPY. Okay, because they are virtual pairs. So now here you shall put the moving averages: 20 exponential moving average and 50 exponential moving average. Here you will see that this blue one, it is 50 exponential moving average, and this black one, it is a 20 exponential moving average, right? So now here we shall wait for the strong trend, okay, price above both of these moving averages. This mistake, most of you people do it. You don't wait for the strong trend, okay, above or below the moving averages. That's why you'll always fail with this strategy. You have to wait for strong trend above, okay, the trend is above or below the moving average. Then after identifying that yes, it is above or below, now for example here, this is our time frame, you'll see that this one was strongly below the moving average, right? Because you can see it right here, it is strongly below the moving average. So now after identifying that, you have now to do it. You have to wait for the pullback to the 20 exponential moving average. Comes back to your 20 exponential moving average, and also you have to add it with a different strategy. So you should not only use this trend line strategy only, but you have to add it with a trend like break of market structure, and also add it with candlestick confirmations, right? So now for example here you can see that the market came back right here. It came back to the 20 exponential move. And remember we said this black one is a 20 exponential. So now the market came back here, and after coming back here, we always use candlestick confirmations. It made a bearish signal, right, saying that we are going down. Okay, it made an insider candle. That means it first created this bullish momentum candle, then it created this bearish candle on the 20 exponential moving average. It rejected this moving average. So now here traders would just come and enter from right there. Okay, you just enter your sell position immediately after the market giving you confirmation right here, guys, right? Hope you're getting it. So now after that, we always put our TP right here on this high. Then the stop loss, it is above this, right? It is above that that candle, right? So now this is what I mean by break of market structure. Now it has created a low. That means after creating a low here, it was your role to mark this low. This was a lower low, right? It was a lower low. That means when you create a lower low, it will go back to your moving average for another selling position, for another selling opportunity. But when you see this here closely, it didn't tap our moving average. When it doesn't tap our moving average, we just wait for it. So now, for example, here you can see that it didn't tap our moving average. That means you just leave it. Then here, you mark another moving, another break of market structure right here. Can you see that another higher low didn't come to your moving average? You also don't take it so much serious. Then you come for another break of market structure right here. See that you'll see now, for example, this time around, the market, it came and tapped your moving average and rejected it with a bearish confirmation, right? You can see that this was most of the confirmation we use, this bearish engulfing candlestick pattern. We always use this, by the way. So you can see it created this bullish candle, then this bearish candle engulfed all this bullish candle, giving us a confirmation of selling opportunity, right? So now traders would just come and enter immediately after that confirmation. Then here you always risk a 1 to 2 or a 1 to 3. These are 20 pips and these are 40 pips. It is a 1 to 2 trade, right? So now it is upon you guys to use this strategy very well. Then for the bullish example, you can see that here it was extremely above these moving averages, and we said when it is above, we always look for bullish setups. Okay, so now here we already say that you have to first mark out your break of market structure. For example, right here, this was a break of market structure. The upside, it created a high, right? This is the high it created right here. Then after creating this high, okay, we said that we want the market to come back to our 20 exponential moving average. You can see that it came back to your 20 exponential moving average right here. You can see all these are bullish signals. This is a bearish engulfing candlestick pattern. This is an insider candle. Okay, these are doji candles. All of them, this is a hammer, sorry, and all of them, they are rejecting our 20 exponential moving average. That means there was a good buying opportunity right there. Then also here, when you see the bearish momentum, that was a high. So it created that high. Then you'll see that when it come back to your moving average right here, can you see all this? This is a bullish engulfing candlestick pattern. This is a bearish one, then this one engulfed all this, confirming to us that this one is what is good confirmation for us to enter. Okay, so now that's why here traders would just come and immediately enter. Then here you put your stop loss down here, down this candle, almost 20 pips. Then you target a 124, 123. Okay, so that's an easy strategy that you can use in your day trading to get most of the setups right. Okay, so now hope this video has helped you guys. Thank you for watching, and subscribe and give a like to this video. Bye.